Tim Baker, glad to have you back on the show.
Good to be back. What's new, Tim?
I think this is back to back, right? It's been a while since we've
Yeah.
done back to back. So last week we talked about couples working together with their finances, certainly a relevant and important topic. And today we're going to go pretty narrow and pretty nerdy. So we talk about rebalancing your investment portfolio. And Tim, let me start with that. We talk a lot about our savings rate and how much we're going to save and how much we need to save for retirement. And sometimes what we lose in that conversation, certainly not with clients when our team's doing this one-on-one, but maybe in a broader education sense, is how we actually allocate those assets.
Yeah.
Where do those dollars go? And then what do we do when that asset allocation perhaps gets out of whack over time, which is our topic with rebalancing. So I think naturally there can be a focus on the accumulation, but we might lose some of those details along the way.
Yeah. I mean, it's an important thing to consider because what we're really talking about here is like maintaining the amount of risk that you feel comfortable with. And for a lot of people, like, I don't even know what you're talking about. So I'm just putting it in a target date fund. So if you're in a target date fund, primarily this episode won't apply to you, but if you're kind of pulling the strings and want a little bit more precision, want to pay a little bit less, that's one of the beasts that I have with target date fund. This will be an episode to kind of tune in and listen to in terms of, at least how we approach it.
So let's start with just defining rebalancing and maybe at the same time define asset allocation because those are going to go hand in hand.
Yeah. So asset allocation is really just the percentages between stocks and bonds at a high level. So, if you're in, say, an 80-20 portfolio, that means 80% is in stocks. So you think traditionally more exponential growth, more stocks in an accumulation phase. And then bonds we typically explain as more like linear growth. So this is where it's fixed income, you're being set, being paid, interest and those types of things. So typically the higher the bonds, the more risk avoidant you are. And typically this is for people that are approaching retirement or in retirement. So the percentage of stocks and bonds is really what we're talking about with that asset allocation. Rebalancing is the process of realigning the asset allocation of your investments to maintain whatever your desired level of risk is and return. So over time, Tim, the market fluctuates. Obviously, it goes up and down, and certain investments may grow faster than others. So this causes your portfolio to drift from its original target allocation. So to give you an example, let's say your target allocation is fairly conservative. It's 60-40. So 60% in stocks and 40% in bonds. A strong stock market, which we've been experiencing lately over the last couple of years, although volatile, could shift that to a 70-30 ratio. So if you're in a buy and hold strategy, which is basically you buy and set it and forget it, you're going to continue to drift 70-30, 80-20, which ultimately increases your portfolio's risk. So what rebalancing basically involves is selling some of the stocks and buying bonds to return it back to that original 60-40. So basically, you sign up for a certain amount of risk, whether you're working with an advisor or just in your own mind. And as the market does what it does, the percentages shift and you just want to basically reset that. So in the event, I always kind of think about in the event of, the market taking a significant downturn, you're protected as much as you can be with the percentages that you signed up for.
Yeah, and for the DIYers out there, right, this is something they have to keep on their radar to come back to at some frequency, whatever that might be determined. Or, of course, we're big advocates of, hey, this is one of the many things that a financial planner can help you with. Like I selfishly know that, hey, I've got Kim on our side, in our corner, one of our CFPs that, like, I'm not thinking about risk. I'm not thinking about the rebalancing. Of course, we're constantly reevaluating what are the goals, what's the risk tolerance, what's the risk capacity. But that aspect's being taken care of as naturally market fluctuations will happen. So, Tim, what accounts should people be thinking about here with rebalancing? Perhaps the obvious people are thinking, oh yeah, my 401k, but it's bigger than that, right?
Yeah, it's pretty much all of your investment accounts. So, IRAs, HSAs, if you're investing in your HSA, 401ks, 403bs, TSPs, brokerage accounts. And to kind of drill down a little bit more, Tim, it's not just like, stocks and bonds. If you look in the
Right.
equity side of your portfolio, it could be that small cap has outperformed. So, we have to sell some of the small cap to maybe redeploy that
Mm-hmm.
into emerging market or an international exposure. So, but really is anything that you have, investments, right? Which could be IRAs, HSAs, 401ks, a brokerage account. These are the accounts that you want to pay the most attention to. Now, I would say that 401ks are typically there's a less of a need to rebalance a 401k. And the reason for that is typically 401ks are contributed to every pay cycle. So if you get paid
Mm-hmm.
24 times a year, every time some of your paycheck goes in, it's almost like a natural
Makes
rebalance, right?
sense.
There's still some drift there. And it's still important to look at this because oftentimes this is the biggest asset that many of us have
Mm-hmm.
outside of maybe a home. So it's a big asset on the balance sheet that needs attention. But oftentimes you kind of have that natural rebalance because of how regular the contributions are made into your
Mm-hmm.
401k.
Yeah, and I would add to this, you mentioned kind of the various accounts, right? So 401ks, IRAs, TSPs, 403bs, HSAs, 529s would fall in there, right, as well, if we're
Yeah,
invested.
457s. Yep,
Yeah.
exactly right.
I think too, it's worth mentioning this. I'm thinking of the DIYer in particular, where I often see this overlooked, Tim, that there's a question behind this question that we can't overlook, right? So the question we're addressing is, what is rebalancing? And we'll talk some about the strategies, what accounts need rebalancing, and ultimately, how does that connect and relate to your risk tolerance and capacity? All important stuff. But the question behind that is like, where are we going with these investment accounts? What's the overarching goal? What's the target amount that we're trying to achieve? And how are we balancing that with all these different goals? Once those decisions are made and those conversations happen, then within that, we can begin to think about, okay, how do we make sure we rebalance and keep on track with the plan that we set?
If you're looking at a checklist of reviewing your financial plan, this is probably item number 82,
Right.
and all of the other things, that are going to be important of like, hey, where are we at? Where are we
Hmm.
going? What's the purpose of this? Are the things that we talked about, last year, the year before still important?
Right.
So I think this is very much the technical after all of those really value-based conversations and questions are
Hmm.
answered, but it's important all the same, right? So I think that, you know, um, and this changes, right? So what your there's so many people are like, like nothing's going on, like I got this. But I always like do the thought experiment is like, even for us, Tim, if we look back at like 2 years ago, how much things have changed over
Oh my
these last two
gosh. Yeah.
years.
Hmm.
And I think as humans, we think we kind of lose sight of that, and we think
Hmm.
that the next 2 years are going to be, kind of laissez-faire type of thing. So I think yeah, this is an item on a long list of things that need to be answered, and I think it's just important to ask that question,
Hmm.
kind of do that mental azimuth of like, is this still kind of serving me and what I'm trying to accomplish with my financial plan?
Yeah, and I want to make sure to say that out loud and we don't miss that because, the thought that was coming to mind, Tim, that stimulated that comment was there's a lot of work that has to be done to determine what percentage of our income are we saving and why are we saving it? And then within that conversation, what vehicles are we going to use? And then within that conversation, there's the risk tolerance, risk capacity rebalancing. So making sure we just don't get lost in the weeds, right? Especially for people that
Yes,
are DIY in this.
correct.
Um, let's talk. I keep throwing around these terms: risk tolerance, risk capacity, but so important, right? Because that ultimately is going to inform what is your asset allocation, which will then inform what are we going to do with the rebalance. So, talk to us about risk tolerance, risk capacity, and then even a peek behind the curtain for those that are financial planning clients, how we handle this through something like an investment policy statement.
Yeah. So the way that I simply put risk tolerance versus risk capacity is risk tolerance is a risk that you want to take. The risk capacity is a risk that you should or need to take.
Mm,
So I'll give you an example. I could be a 35-year-old pharmacist, and I could be very risk adverse, right? So when I take a questionnaire about how I view my investments and how I view about money, I'm like, I just want to keep, I don't want to lose anything. I just want to, I'm much more comfortable putting everything into a high yield savings account and doing
Mm-hmm.
my thing there. The problem is because we know about things with inflation and um, taxes that
Mm-hmm.
we have to do more than the 3% or whatever a high yield savings account is paying these days. Like we have to outpace inflation. We have to outpace the tax man. So although our tolerance is lower, we want to be more conservative. If you're 35 or 40 years old or younger, or even a little bit older than that, you have more capacity to take risk if we're thinking about it in terms of retirement planning,
Mm-hmm.
because I might have 30 years to invest. And the idea is that the longer time horizon that you have, the more capacity that you have to take risk, because the more likely that that portfolio can recover over those 30 years. So as you get closer, I could be the most, so I pretty much like pretty aggressive with my investments. But once I get to, if I'm going to retire at 65, once I get to 55 or 60, I don't have the capacity to take the
Mm-hmm.
risk because my time is so short. So even though I'm aggressive, I need to know, I in the back of my mind, I'm fighting what's called sequence of return risk, where if I'm 58 and I'm trying to retire at 60 and I'm super aggressive and my portfolio, drops by a third, it's hard for me to recover
Sure.
in a
Mm-hmm.
2 year period. So risk tolerance is what you want to take. That's kind of your emotional response. The risk capacity is what you should or need to take. And sometimes if you're 50 years old, 60 years old, and you're trying to retire in the next 5 or 10 years and you haven't done much, your you have to take more risk because you have no choice, or you're going to just be working forever. So
Mm-hmm.
there's this Venn diagram, Tim, of what we kind of look at your risk tolerance, which is typically a result of a questionnaire that we do. And then we overlay the demographic of how much you have saved, what your age is, what's your time horizon. And we come to that asset allocation of, the magic percentage of stocks to bonds. And then to kind of answer your question, what we typically do at YFP is we just have a 1-page document. We call this the investment policy statement. This is kind of our North Star of how we're going to
Mm-hmm.
manage your investments, both the ones that we are managing at our custodian directly, but also held away investments, which are typically 401ks or 403bs that you're contributing directly, because you're still employed. So that investment policy statement is kind of like our instruction manual of how we're going to, what the asset allocation is, how we're going to rebalance, how you have visibility, that you'll receive statements and all that kind of stuff. So it's really kind of a North Star of how we're going to handle the investments that gives us kind of a scalable way to manage millions of dollars for our clients, but also for the client to understand, okay, this is
Mm-hmm.
what the team at YFP, this is how they're handling, my long-term investments, et cetera.
Yeah, and I think that helps people, especially if they're new to that relationship, feel
Yeah.
comfortable of like, hey, we've been through the evaluation of risk process. We've agreed upon these set of terms, but I'm also in part delegating this work to the team I hired, but I'm delegating this work to the team that I hired within the sandbox we've agreed upon,
Correct.
which I think is really important. And I love your visual, the Venn diagram, right? Because I think it encompasses when we talk about risk capacity, risk tolerance. Yes, we're thinking about the emotional part, how much risk can I stomach, but we're also considering how much risk do I need to take based on all these goals. And that's where a third party can really have a valuable role of like, let's talk about both of those things. And where there may be differences, let's have a conversation and kind of figure out what gives, right? Are
Yeah.
we willing to push ourselves maybe a little bit in a direction that we weren't thinking, or are we willing to adjust the goals? Oh, and by the way, when you have two people doing this, partners, spouses, significant others, you might have two different risk tolerances and risk capacities that you're dealing with. And to have those conversations can be really valuable.
Yeah. And I think one of the things that I, ultimately say, when I was working with clients back in the day is, at the end of the day, it's your financial plan. So even though I might
Mm,
you might come in at a 730, a 70/30, and I think that you can be more aggressive, 90/10 or even 100/0, all equity portfolio. I've had some clients will say like, let's start at 80-20. And then I just say like, I'm just forewarning you every time we meet, because you're 28 or whatever it is, like, I'm just going to bring this up that,
Mm-hmm.
we need to be more aggressive. And, ultimately clients might step into that over a couple years, because I think they realize it's working smarter, not harder. Because again, typically the more conservative you are, the harder you have to work, i.e. save or work longer to kind of reach that portfolio amount that we can have a
Mm-hmm.
sustainable paycheck. So, and that goes back to, in the past, I've talked about aggressive Jane and conservative
Mm-hmm.
Jane, and everything being equal. And the delta between their portfolio after a 30-year career is significant. And the only thing that really changes is the asset allocation.
Yeah.
So it's one of the most powerful things. And I think tending to that, i.e. through a rebalancing strategy over time, is going to be really important as well. So, yeah, at the end of the day, you have to feel comfortable. But
Mm-hmm.
I think what most people realize is, hey, even if the portfolio goes down in 2025 and I'm retiring in 2055, who cares? Right? It doesn't matter. We're not even going to remember that. And in fact, we're going to probably have, 6, 7 more of those. It's just when we get to that eye of the storm close to retirement, that's when we really need to be hyper focused and conservative on the asset allocation, so we don't, again, fall to sequence of return risk.
Yeah, and it's worth noting, Tim, especially for newer investors, how you think you're going to feel and how you actually feel might not always line up, right? Until you go
Yeah.
through a dip where
Yeah.
you have a sizable amount of assets and kind of experience that. I do think some people go into that thinking, hey, I'm in this for the long term. I can stomach it. And the market drops 30%. And they still feel the same way. Like, that's fine. I'm in it for the long run. I think other people might go into that with that same mindset, see that number go down on their accounts, and all of a sudden there's this gut feeling of like, whoa, I didn't think this would impact me in the way it did.
Yeah, and sometimes that gut feeling leads to that whole idea that I talk about, is like, I want to take my investment ball and go
Yeah.
home. And then that could lead to really, um, the word's not inappropriate, but really unproductive
Hmm.
decisions and actions with your portfolio when you're selling into cash. Then you start feeling a little bit better because the market's recovering, and then you
Hmm.
buy back into the portfolio higher. And it's probably one of the biggest mistakes that novice investors make. And it's basically playing on our loss aversion that
Hmm.
affects all of us. So,
Let's go there to common mistakes investors make when rebalancing. You're talking about one really important one right there. And specifically, I'm thinking about the DIY investor where, hey, when the hand's in the cookie jar, we might make some mistakes or be more prone to making mistakes than we would be otherwise if we had a financial planner advisor, someone in our corner kind of talking through some of these things. So what are some of those mistakes that folks should be aware of that, hey, we can avoid these if at all possible related to rebalancing?
yeah, so I think it's kind of what I just said, is like that emotional reaction to this, or taking a short-term view of a portfolio that has a long-term outlook. Um, you know, I think sometimes, like, in rebalancing itself seems unnatural, because you're taking your highest performing asset class, some of it, selling some of it, and
Right.
putting it potentially in your lowest performing asset class. So it feels weird. Um, again, if you're overwatching your portfolio, it could lead to you making irrational decisions to time the market, which we know over the course of a long investing career, you just can't do.
Hmm.
Um, I think the other thing is not considering the shifts in risk tolerance over time, right? So if you set this and forget it in early in your career, and then your mid career and late career, you're still in that same asset allocation, there's a problem there. Um, and I think the other thing too, that is kind of related to this, but tangentially so, is like, if you're thinking like, oh, I'm in a target date fund, I don't have to worry about that, like in my 401k. That is true to a degree, but the other thing is, like, we've talked about, like, not all HSAs or 401ks are created equal. Not
Hmm.
all target date funds are created equal. So you could be in a 2060 target date fund that's actually too conservative to what you actually need to be in. And even, all of those, as they lead up and they kind of have this glide path of, taking out equities and reinvesting into stocks and bonds. It's not necessarily lines up with what you're thinking. So all those, the easy button, I would say look at the fees and look at the actual
Hmm.
asset allocation within that fund to make a good decision. Um, I also think not considering tax consequences in certain accounts or chasing something because of a tax benefit. So
Mm-hmm.
the big thing that we haven't talked here um, is like rebalance is different in a brokerage account versus a 401k or an IRA. Um, and what I mean by that is we've always talked about like the tax benefits of a 401k or an IRA or a Roth IRA. The in those accounts, the money that is in those accounts is either tax going in, so that's in the case of a Roth, or
Mm-hmm.
tax going out, which is the case of the traditional. The added tax in a brokerage account is that when you buy and sell a stock, bond, mutual fund inside of a 401k, you pay no capital gains. So the growth is tax free, which is another benefit of those accounts. Inside of a brokerage account, you're paying capital gains on any gain
Mm-hmm.
or loss in the side of those accounts. So sometimes we do weird things because of tax ramifications. And I think it is not losing sight of that, as well. And then I think also kind of related to this, Tim, is account location. So this is kind of related to rebalancing, but having a good amount of, we just signed on a client recently that they're in their early 40s. They want to retire in their early 50s. So they have about a decade left,
Mm-hmm.
but they have nothing in a brokerage account, which is typically what we're going to use for an early retirement
Mm-hmm.
paycheck. So this is kind of do we have enough in a taxable pre-tax and an after-tax to basically build a sustainable paycheck. So not necessarily related directly to rebalancing, but important to know, again, as you're asking yourself those questions and we're getting to that 80-second step of rebalancing, that we could look at the situation and be like, our account location is off. So we need
Yeah.
to reallocate assets that way, and then obviously rebalance the portfolio in general.
And that's a great example, right? Because that's one of those in the weeds types of things where we can be, knee deep and trying to rebalance within an account, thinking about the asset allocation, maybe even trying to think about some of the tax benefits, especially if it's not in a retirement account. All the while, a bigger question of, hey, might I need these funds prior to traditional retirement age? And do we have the right account locations? A really good example of the bigger puzzle that we need to be thinking about.
Yeah.
Last question I have for you here is on timing, Tim. So we've established that, hey, once we set an asset allocation based on risk tolerance, based on risk capacity, based on goals, that asset allocation will inevitably shift as the market does its thing over time, which then puts in the need for what we're talking about here, which is rebalancing. So then the next natural question is, well, how often should I do that? Is this once a year? Is this twice a year? Is this it depends based on market volatility and some seasons of the market may be more volatile than others. What are your thoughts here on timing?
Yeah, so typically the three common approaches to rebalancing is time-based rebalancing, which is kind of what you're talking about. So rebalancing at regular interviews, i.e. quarterly, annually,
Mm,
maybe even semi-annually. It could be threshold-based rebalancing, which is rebalancing when an asset class deviates from the target by a certain percentage. So if it drifts 5% or 10%, then we rebalance. And then there's a hybrid approach, so combining time and threshold methods for more flexibility. Back in the day, Tim, this was a concern because, and even I think even today it's a concern depending on how your invested is. We would rebalance in my previous firm, we would rebalance like mutual funds. We didn't use
mm-hmm,
ETFs, which is what we use now. And those would generate like ticket charge and commissions.
mm-hmm,
Um, and so some of the listeners might have heard of things called like churning, where an advisor is kind of selling, not unnecessarily, but in a rebalancing to kind of earn a commission. And even ETFs or stocks, anytime that you buy and sell, sometimes there's a ticket charge. Now, a lot of those have kind of gone to zero, so you're
mm-hmm.
able to do this kind of at will. But that was a something that you had to be aware of back in the day of either, what's the ticket charge related to the trade, or like what's the commission that you're going to pay an advisor. So obviously being fee only, we don't earn commission since that's not part of what we do. Um, Today, a lot of these methods are going to be threshold based. So if you're working like with a robo advisor, it's gonna look at a drift at a certain percentage and then basically realign you.
Mm-hmm.
Obviously, you're paying a fee for that. what you need to know what that is. But we kind of do a hybrid approach of both. Some people want to overdo this and rebalance this, if you're a tinkerer, and that's typically not the best approach. So I would say at a minimum, at least once a year, you should be looking at this and rebalancing back to a target percentage. And again, having those conversations with yourself about, is this what I still want and need? And how is this best supported my financial plan?
Awesome, Tim. Great stuff. Appreciate your perspective as always. And for those that are listening, saying, hey, I could use help with rebalancing, asset allocation, making sure I'm thinking about my risk tolerance, risk capacity, and other investing goals, as well as other parts of the financial plan. That's what our team of fee-only certified financial planners do at YFP. Again, we're talking about a very narrow aspect of the financial plan, and there's so much more opportunity beyond just this topic as we look at all of the different parts of the financial plan, whether that's investing and retirement planning, whether that be debt management, credit, estate planning, insurance, and so on. So to learn more about what it means and what it would look like to work one-on-one with a YFP fee-only certified financial planner, head on over to our website, yourfinancialpharmacist.com. You'll see an option there to book a discovery call. We'd love to have an opportunity to talk with you, learn more about your financial situation. You can learn more about our services, and ultimately we can determine together whether or not there's a good fit there. Again, yourfinancialpharmacist.com, and click on the link to book a discovery call. Thanks so much for listening. Have a great rest of your week.